Welcome to Kitco News. I'm Niels Christensen. Joining us today is Jasper Lawler, Head of Research at London Capital Group. Thank you very much for joining us today, Jasper.
My pleasure. Thanks for having me, Niels.
Excellent. I really wanted to talk to you about market sentiment, market optimism. Last week, Friday, we saw 20 million job losses in the U.S., biggest job loss in U.S. history. And yet markets didn't really react. I mean, we have the NASDAQ positive on the year following that report. Is this misplaced optimism, or is this the bounce as we price in the bottom?
I think you're right to highlight the report because I think it says precisely where we are at the market in the market at the moment, and that's basically the economic data almost doesn't matter. I mean, 20 million Americans out of work, that's horrific. But it's all being set aside because there's this idea that this is temporary, it's artificial. And so it all really hinges on the easing of the lockdown measures. And so while, of course, America's still in lockdown now, there's a huge number of jobs that have been lost. We don't know how many of those just automatically return should there be some perfect scenario where the lockdown is eased and companies keep going with the help of all this government stimulus. So there are a range of scenarios, and that's why I think at the moment there is an element of the markets pricing in some of the best of those scenarios, but it's an unknown for the present of what that 20 million means. It's not the kind of permanent situation that kind of figure would normally mean.
But I guess, even if we see, I've sort of done quick calculations. I mean, even if we see an 80% or 90% recovery from what we're seeing now, that's still 4 million to 2 million jobs lost. Even best case scenario, we're still seeing lower economic growth. And I'm sort of wondering, I mean, how do you think markets should be pricing that in? I mean, should they be positive on the year if even in a recovery we still see millions of job loss similar to what the 2008 financial crisis had?
Yeah, and I think the market action today is interesting, where it's mixed on Wall Street. You've got the major averages, which at least opened lower, and the NASDAQ obviously outperforming. I think part of what you're seeing is that the technology companies are just still outperforming, and now this is a bizarre scenario because they were performing for so long before the pandemic. But then I think what we're seeing now is that this pandemic is exacerbating. It's actually accelerating these trends in the way we interact with social media, through retail, through e-commerce, through how even business is conducted through the likes of Zoom, etc. These companies are actually doing even better, if you like, during this pandemic, and their outperformance, their potential growth versus the rest of the market is actually widened. And so I think when you look at the NASDAQ, it's a technology idea, and then when you look at the rest of the market, it's nowhere to be seen.
And also too, I think we can't ignore the Fed's role in sort of this mispricing or optimism in the marketplace. Obviously, we've seen expectations now fall to negative interest rates in the U.S. What are your thoughts on that? Do we see the Fed go negative?
Well, I absolutely go along with that. I think this whole rally has basically been a liquidity-driven rally, and it goes a long way to explain why, despite having a quick drop in March, gold is right back up near its multi-year highs. I mean, it's liquidity-driven, and so that's why I think probably the next stage of gains in the stock market are going to be a lot harder work, because it's going to be more as a result of real expectations for the economy and for company performance. But I think as far as the negative interest rates go, what I suppose I think there is that probably, and this again is hoping for logic on the part of central bankers, which may be unrealistic for me to hope for. But the hope is that actually we've seen what negative interest rates have done in Japan and Europe. And actually, for the most part, it's not been a particularly successful experience. It's been pretty awful for the banks. You look at the outperformance of US and Canadian banks versus what's happened in Europe, and it's a wide margin. And a lot of that has to be attributed to the negative interest rates. what I think probably, because they're interest rate Fed funds futures, obviously their function is through interest rates. But I think what they're pricing is probably just some sort of extreme action. So negative interest rates are extreme. But I think the Fed probably doesn't prefer to go that way. But I think some other things, like direct FX intervention to weaken the dollar, should we get another bout of dollar strength, something along those lines are probably more likely when we get that next dollar move and next sell-off in stock markets.
That's quite a call there. Do you think like just FX intervention by the Fed would be astounding? I think, but it does seem realistic because it just like, do you think they have much ammunition left? I mean, you look at the alphabet soup of programs they've launched. I don't know how much money they can throw into financial markets right now.
Yeah, I think you've hit the nail on the head. They've already announced they're going to buy as much as possible and as needed in terms of the quantitative easing. So they've drained that barrel. The quantitative easing, that's already all in. If you make that assumption that negative interest rates don't work and that they are not going to choose that option, then you have to start to look around, well, what else is there in that rather empty-looking toolbox? And there isn't a lot. And if they deem the dollar and the issues around funding as being one of the key problems that almost exacerbates other market moves, financial tightening, as they like to call it, then you can get to a situation where, as crazy as it seems now, the FX intervention actually becomes a default policy route.
Let's turn this conversation to gold now. I mean, obviously, like you pointed out, massive liquidity is helping gold reach multi-year highs again. What are your thoughts on the price? And I wanted to mention, last time we talked, actually, in January, you said that gold wasn't really an inflation hedge, but you should be looking at it as a portfolio risk hedge. That seems like pearl of wisdom in this day and age right now that we're living in. So like, what do you think? What are your thoughts on the yellow metal?
Yes, I mean, I think there's still room for gold to be an inflation hedge, but we don't. It's more. It's looking very far out into the future when you see the effects of all this monetary easing coming through in inflation. It doesn't seem like it's happening now, but it seemed clear to me at the start of the year, and it still seems very clear to me now that there's a lot of risk out there in the market. Whether you believe stock markets are heading higher or not, and you want to have a portfolio of stocks, it still just makes so much sense to have gold in your portfolio. And I think that's true of investors, but I think that's also true of central banks. And I think it's no surprise that all the inflows from central banks into their reserves for gold has been on the rise since 2010. And that certain central banks are favoring gold in their portfolios, Russia and increasingly China. I mean, China only has, last time I checked, has 3% of its reserves in gold. There's a logic for investors and central banks alike to keep increasing their gold position just purely to diversify away from some of these traditional assets which have some unusual things going on behind them, namely this very accommodative monetary policy.
To put your feet to the fire a little bit, where do you see gold prices? What's your short-term, medium-term, long-term forecast for the price?
Well, I think we've resolved higher in this short-term consolidation. It's around $1,700 per ounce. We had the big sell-off. We recovered very quickly. To me, it's all looking very, very bullish for the price. Of course, there's always risks. I think probably the biggest one of which is that we get another risk-off tone in markets, and we see a swoon in stocks for a couple of weeks, and probably gold gets thrown out of the bathwater like it did last time. But even if that happens, I don't see us getting back below that $1,500 per ounce mark. I think the cat is out of the bag here. Gold is in a bull market. People are aware of the quite crazy liquidity situation, the money printing situation we're in, and that gold prices are heading high. Towards the end of the year, it's so difficult to forecast, obviously, because we're all watching what happens with the pandemic. But back to the point we made originally, gold is still a portfolio hedge. And so I think that remains the case for the rest of a very uncertain year, even if equities move higher. And so then I think once we resolve from this consolidation we're in at $1,700 per ounce, I easily think we get a couple of $100 higher from here. And then suddenly we're talking about $2,000 an ounce again.
Thank you very much for your insights. It's been a pleasure talking with you today. I guess we just sort of wait to see what the Fed does.
Yes, as always. What does Jerome do?
Thank you for joining us at Kitco News. For the latest information in the precious metals markets, go to kitco.com.